numbers reported by the company, so let's cut across.
Quarter, we have seen a very stable growth rate. In fact, on the back of strong pipeline of loans coming from tier 2, tier 3 markets, the sanctions have moved up by more than 20%, and so have the disbursements. As we stand today, our current assets under management is more than 63,000 crores. The overall performance of the loans continues to be fairly satisfactory. Our gross NPA is below 1% at 0.8%. Our net NPA is at zero. From a strong governance standpoint, we have a strong provisioning coverage of more than 110%. So all in all, it's been a very satisfactory performance. The net interest margins have been fairly stable. We are at about 2.86%, and the trajectory seems to be between a 2.8 and 3% level. Overall, the reduction in interest rates has also been a big kicker as well in the market. We are seeing the sentiment improving in a lot of the tier 1 and tier 2 cities on the back of reduction that we saw in interest rates by the RBI and the subsequent reduction by all the other banks and institutions. We ourselves have been fairly active in the low middle income segment and have come out with a very competitive offer of 9.55%, which is for the festive season. So all in all, as we have seen in the last 2 quarters, the next 2 quarters also look, we believe it'll be a fairly stable growth rate over the next 2 quarters as well. I think we anticipate that our assets under management will be closer to about 70,000 plus crores as on 31st of March.
So one question on your margins that have dipped slightly. Is it purely because of the prime lending rate cut that you've undertaken?
I think this is a recent cut, so it's got nothing to do with any adjustment in the margins is on account of so for example the deferred tax liability has been a pushback as far as our margins are concerned, because that directly comes from your profit and loss account. But all in all, a few basis points here and there, is not significant.
Could you highlight on cost of funding?
Our cost of funding has been coming down. In fact, our weighted average cost of funding is below 10%. With this reduction in this round, we have seen our cost of funding coming down to even below 9.7. Which is quite satisfactory.
How many more quarters of this deferred tax liability do you have to pay, and what is the total quantum you can just quantify?
I think it's a regular process. So every quarter you have to keep on providing for this deferred tax liability. This quarter again we have provided. I think it was more than 30 crores, which has gone towards this liability. But I think it's a continuous process and it's not driven quarter by, so it's not a one-time charge.
After RBI cut, can we see the improvement in margins as well as in net interest income?
As I said, we have, being a pure retail housing finance company, please do not expect very high margins from us, as is the case with some of the other financial services entities doing housing finance. We want to maintain a stable margin and pass on the benefit to the end consumer, which is very important to our DNA as a housing financier.
Do you have any plan to divest any non-core businesses?
I mean, we have got into a number of other financial services businesses, including life insurance, asset management. Now these have been recent forays. We see a lot of value build up in these businesses. So for example, the life insurance business is doing extremely well. In fact, we are now a profitable life insurance company, and even this quarter has been a strong performance oriented quarter for that business. So yes, there is no intent to divest. Rather, we want to build value in whatever we are doing.
You said your cost of funds has been coming down 1.7% and the reduction you undertook is only for a limited period. Beyond that, will you look at reducing your rates further?
I think it's really dependent on where the cost of funding goes on an incremental basis. So whilst the weighted average cost may be coming down, and part of that benefit we have already passed on, by reducing our retail prime lending rate to the existing customers. I think it really is dependent on where the overall cost in the.
But is there headroom right now?
I believe RBI clearly has an opportunity to reduce rates further, which surely will have a positive impact by companies like us coming out and passing on that benefit to the consumer.
You picked up that 50% stake in Pramerica, which deal was concluded in this quarter. Could you take us through your business outlook for that insurance business, the AUM business?
I think it's very clear that the asset management business again is fairly underpenetrated if you look at the overall penetration to GDP. We are a $2 trillion economy and slated to grow to $3 trillion by 2020, and that's the estimates coming in from the IMF. Clearly the people are looking at alternate avenues for investment, and what better avenue than coming to a mutual fund and making investment, because that gives you strong diversification benefits both on equity and debt. Yes, we got into this business,
All right, that is the word coming in from Dewan Housing. The stock is now correcting a bit, coming in for profit taking. There's some news coming in on Tata Steel on the UK unit. The restructuring of the UK unit could lead to about 1,200 job cuts. So that's the latest coming in on the restructuring plan of the UK unit. And that stock, as you can see, is down almost about 2.5%. 1,200 job cuts could be on the cards. But let's do one thing.